Hello, thanks for watching. Welcome back to the next video in my series. Now, as usual, a few things before we get started. Please feel free to follow me here on YouTube, Facebook, TikTok, or Telegram. That's way when I upload a new video, you know about it, and it's always nice to connect with my viewers online. If you like the video, please give the thumbs up, share it with classmates or colleagues, or put it on a playlist. That does encourage me to keep making them for you. If you think there's something I can do better, please leave a comment below the video, and I will take those ideas into account when I make new ones. Let's get started.
The accounting equation is a fundamental principle in accounting that represents the relationship between a company's assets, liabilities, and equity. It's like a mathematical equation that always needs to be balanced. Here's the equation. Assets equals liabilities plus equity. Let's break down each component. Assets. These are things a company owns that have value. Think of things like cash, buildings, equipment, and even things like patents or trademarks. Liabilities. These are the company's obligations to others. Examples include loans, accounts payable, money owed to suppliers, and deferred revenue, money received for services not yet provided. Equity. This represents the owner's stake in the company. It's what's left over after liabilities are subtracted from assets. Equity can come from investments by owners or from profits the company has earned and kept. Here's how it works. The accounting equation ensures that every transaction a company makes is balanced. For every change to one side of the equation, there must be an equal and opposite change to the other side. Example. Imagine a company takes out a loan for $10,000. This increases the company's assets, cash, by $10,000, but it also increases its liabilities, loan payable, by $10,000. The equation remains balanced. Why is the accounting equation important? Foundation of double-entry bookkeeping. The accounting equation is the basis for the double-entry bookkeeping system, which ensures that every transaction is recorded accurately. Balance sheet. It's the foundation of the balance sheet, one of the key financial statements that provides a snapshot of a company's financial health at a specific point in time. Analysis. By analyzing the accounting equation and the relationships between its components, you can gain insights into a company's financial position, profitability, and solvency. In essence, the accounting equation is a simple yet powerful tool that helps to ensure accuracy and provide a framework for understanding a company's financial position. Assets are things a company owns or controls that have value. Think of them as resources that can help the business make money, operate smoothly, or benefit in the future. Cash. This is the most basic asset, the money a company has readily available in its bank accounts or on hand. Accounts receivable. When a company sells goods or services on credit, the money its customers owe is considered an asset. It represents future cash inflow. Notes receivable. This is similar to accounts receivable, but it involves a formal written promise, a promissory note, from the customer to pay a specific amount on a specific date. Store supplies. These are the items a business uses in its day-to-day operations, like pens, paper, cleaning supplies, etc. They have value because they help the business run. Equipment. This includes machinery, computers, tools, and other assets used in production or operations. Vehicles. Cars, trucks, or vans used by a business for deliveries, transportation, or other business needs. Buildings. Structures used by the company for offices, manufacturing, storage, or retail space. Land. The property on which a company's buildings stand or land held for future use or investment. Key takeaway. All these items represent something of value that the company owns or controls and can be used to generate future economic benefits. If assets are what a company owns, liabilities are what a company owes to others. They are obligations the company has to outside parties. Accounts payable. When a company buys goods or services on credit, the amount it owes to its suppliers is called accounts payable. It's like an IOU to vendors. Notes payable. This is similar to accounts payable, but it involves a formal written agreement, a promissory note, where the company promises to pay a specific amount by a specific date, often with interest. This could be a loan from a bank or financing for a large purchase. Taxes payable. Businesses owe taxes to the government, like income tax, sales tax, or property tax. The amount owed before it's paid is a liability. Wages payable. Employees earn wages for their work. The amount a company owes to its employees at the end of a pay period, but hasn't yet paid out, is wages payable. In essence, liabilities represent the claims that creditors have on a company's assets. If the company were to be liquidated, all its assets sold off, the proceeds would first go towards paying off these liabilities before any remaining funds could be distributed to the owners. This is a good explanation of how owner's equity works in a non-corporate entity, like a sole proprietorship or partnership. Let's break it down further. Equity. Equity is the owner's stake in the business. It's what's left over after all the liabilities are subtracted from the assets. Think of it as the owner's net worth in the business. How equity increases. Owner investments. When the owner puts personal assets into the business, cash, equipment, etc., it increases their equity. This is recorded in the owner capital account. Revenues. When the business earns money from its operations, sales, services, etc., it increases equity. Revenue shows the business is generating profit and increasing its overall value. How equity decreases. Owner withdrawals. When the owner takes money out of the business for personal use, it decreases equity. This is like the owner taking a portion of their investment back. Expenses. The costs of running the business, rent, salaries, supplies, etc., decrease equity. Expenses represent the resources consumed to generate revenue. Example. Imagine you start a bakery. You invest $10,000 of your own money, owner capital. This increases your equity. You then earn $5,000 in revenue from selling cakes, further increasing your equity. However, you also have $2,000 in expenses, flour, sugar, etc., and withdraw $1,000 for personal use. These decrease your equity. Key takeaway. Owner's equity is a dynamic value that reflects the owner's investment in the business and the results of its operations. It's a crucial indicator of the financial health and ownership structure of a non-corporate entity.
Finally, if you like the video, please give it a thumbs up and share it with classmates or colleagues. Please feel free to follow me here on YouTube, Facebook, TikTok, or Telegram. It's always nice to hear from you. If you think there's something I can do better, please leave a comment below the video. So, thank you very much for watching. I wish you the best of luck in your work and studies. I look forward to seeing you again next time.